Good morning. Our panel, Trends in Early Stage Fintech Investing. We've got three fantastic panelists here. We're going to jump right into it because I've got a countdown clock and they told me to stick to it. I've tried to fudge it before, but maybe not today. But Rebecca, Rick, and Satya are our panelists. I'm going to give them a couple seconds to introduce themselves, and we'll get right into our program to talk a little bit about where we see the future of fintech and what early stage fintech trends are developing in the market right now. So Rebecca.
So Rebecca Lynn, co-founder and general partner at Canvas Ventures. We do Series A and B predominantly. And in terms of fintech, I've invested in Lending Club, early stage, Check, which is personal finance and sold to Intuit, and Future Advisor, sort of in the robo-investing space that sold to BlackRock.
So I'm Rick Yang. I'm a partner at NEA. Been at NEA for about a decade now. We're a very large venture capital firm, sector stage, geography agnostic. I spend most of my time on the consumer and fintech side of things. We'll literally invest in the seed round, write a $100,000 check, all the way up to growth stage rounds of 50, 75, 100 million. On the fintech side of things, we've invested in companies like Robinhood, Plaid, Raise, a bunch of different really interesting companies.
I'm Satya, Patel, co-founder and partner at Homebrew, a seed stage venture fund based in San Francisco. About a quarter of our investing's in fintech, including 5 of the fintech 250 here, Gusto, Chain, Plaid, TrueAccord, and Wealthfront.
I think the great part about the panelists that we have here is they've all had a good amount of success and skin in the game, so we can talk a little bit about what they think could be the next successful stage of fintech investing. So perhaps we'll kick our conversation, and we're going to try to keep it more conversational with regard to the current environment for it. Being a financial journalist, I think we've covered a lot of fintech companies, and it seems like it's the same thing. We talk about the Betterments of the world, the robo-advisors, that sort of thing. I would like to hear from you guys, because you deal with a number of different companies, and you probably get pitches all the time, about where you think there is still opportunity with regard to fintech investing. Is it in robo-advisory? Is it in lending? Is it in things like, I see commercials for Rocket Mortgage on Quicken. Are those types of models the ones that are more attractive right now? And perhaps we'll start with you, Rebecca.
Yeah, so I actually have an operational background in fintech as well. I had been at a credit card company called NextCard way back in the first.com. And so we've tracked fintech and just the disintermediation of banking over time. And I think, in 2010, we did a market map of all fintech, and there were probably 30, 45 companies at most on the entire market map of what was investable in fintech. And today, you could add a 0 to that. And so we're very cognizant of what the competitive space looks like. I actually think where I'm interested now is in the really unsexy kind of areas of fintech. So fraud, compliance, core banking, all of those systems which are very aged and which the banks really do need help with, especially on the fraud front, which has really seemed to kicked into high gear lately.
Is that because of a resource thing? Is that because those types of financial institutions, the old world ones, have the balance sheet or the resources to invest or look to get into this century with regard to
I think there are compliance issues going on. There are a lot of regulatory issues that are coming down the pike that they need to be able to meet. And with the current sort of stack, they're going to struggle to do that. And then you look at just how much money these big banks, the billions of dollars, are spending on just essentially body shops to help them with fraud. I think $6 billion is what Citi's on. And so that's just not sustainable as the fraud gets more and more intense. And so they need systems to actually help them reduce that risk.
Yeah,
I think the most interesting thing is if you look at kind of these incumbents and you look at somebody like a JP Morgan Chase, and as Rebecca mentioned, you think about Citi spending $6 billion. People don't think about these banks as big developer shops, but they have thousands of developers, right? And you kind of think about the venture industry and early stage investing and developers and these fintech companies. Most of those developer resources are focused on very different things than what they are at banks. And so it's actually pretty complementary when you actually think about it.
I think more exciting than potentially selling to the banks themselves is we don't need another consumer fintech app, frankly, that helps you save money. Like, we'd have too many of them. But I think that the reason we have that is because the infrastructure is actually limiting the experience that can be delivered to consumers, to small businesses.
In what way?
It's just so rigid that it limits the types of transactions that can happen, the types of ways that money can be moved, the types of customers who have access. And so all those things lead to opportunity to unbundle the infrastructure that has existed to date so that new products and services can be brought to market, because the fact that we have a Fintech 250 shouldn't be something to celebrate necessarily.
So if we talk about the Fintech 250, obviously CB Insights is very tuned into this whole world. As we talk about maybe the next 5 years, when you look at the Fintech 250, right, where is the predominant heat going to be? Where are we going to see more of the weighting move towards? I mean, I talk about old world indices like the S&P 500, and I can tell you right now 23% of it is technology and around 16% is healthcare and or financials. So as we look at the 250 space, it's obviously all technology oriented, but where are we going to see the most kind of concentration? Where are people pouring the most resources because the opportunities are going to be the biggest there? And Rick, maybe we'll start with you.
Yeah, I mean, I think if you kind of look at the early stages and where we're focusing, I think insurance is a big deal all across the different types of insurance. So you think about P&C, you think about life, you think about health, and these are all very, very different categories. But I think there's a lot of very interesting trends there. There's a lot of technologies that can be utilized to really revitalize the space and offer very personalized products that have never been offered before. I think real estate is another big part of that. And if you look at both of those categories, these are huge consumer spending categories, right? And they're things that people value. These are very emotional products when you look at them. And at the same time, you look at kind of the new wave of consumers and the amount of student debt they're under and how much they don't enjoy or like debt, and you have to think about very creative ways to help them build up their credit, build up kind of their asset base to be able to think about, how do I make these big transactions? How do I make these big purchases that I know I should be making and I know that are good for my financial life, but there might not be a product there that really fits that yet. And so those are kind of the things that we get excited about.
Rebecca, you've done the lending thing before. I mean, Lending Club is probably the biggest name in that space, and it's public right now. So you're out of it. I mean, we know that much. But how much does that lending area become an attractive space? And how much of that is driven by demographics and what the demands are for? I mean, I've been told that millennials just eat avocado toast and they only rent and they use zip cars and that's pretty much it.
Until they have kids.
I grew up in an environment, I'm a Gen Xer, and I grew up in an environment where my dad's like, you want to buy a house, you want to own property. Don't lease your car, buy it, take a 5-year loan out on it, pay it off, and then own it at the end and drive it until it's dead. So how much of these things play into to where you think these things go in terms of the opportunities for investing?
So in terms of lending, I think what people don't realize is there's a lot of exogenous events that make companies very special. And with Lending Club in particular, I mean, that we invested right after Lehman crashed. And so at that time, markets were absolutely frozen. And if you wanted to take out a mortgage, no matter what your dad told you, you had to put 30 or 40% down out of your own pocket in cash, right? And even if you had an 820 credit score. And so that was a very different time. And it gave Lending Club 3 to 5 years of just clear runway in front of it to create a whole new lending space, because acquisition cost and everything else that they would normally have to compete with banks for was very shifted at that point in time. And by the time the banks could sort of react, they were already up and on their feet. And that was actually in our initial sort of thesis and memo. So when all these peer-to-peer sort of lenders come in after that, it's just hard because now you're competing in a full field. And for a lending company to be interesting, it's really one of two things. You either have to have a different sort of underwriting insight, right, or algorithm, or sort of set of data to base that off of, or you have to be phenomenally good at acquisition and have some insight into the acquisition to lower the acquisition cost, or both, hopefully. And what happens when you have, so many lending companies out there right now is that they're all competing for the same customer. Whether, if they're millennial, there's probably 5 millennial, lending companies, and, whatever subprime is the same. So whatever pocket right now, it's just really oversaturated. And what that does is just drive the cost of acquisition up for everyone, and it makes it difficult to actually have a business there. And I think where it's interesting is sort of in the underserved categories. So people that, if they have some interesting insight in terms of how to serve millennials in a specific way, or to Rick's point, is there different data that you can base this off of? Maybe their credit history isn't being built in the same way, so can we be creative about how we actually score and underwrite millennials and people in different credit pockets?
The consumer space, Satya, is saturated, and you're not finding it very attractive. You said it just about 5 minutes ago. So when it comes to things like lending, or it comes to insurance-type products, more consumer facing. Is it fair to say that you're not as excited? And if you're not, what has you excited? I mean,
Yeah,
I want to know what you think about that.
You know, we're investing at the very earliest stage. So for us, we actually believe it's a great time to invest in lending as an example, because it's out of favor everywhere else because of what's happened in the public markets. So like in many markets, there'll be a rash of companies that come into a market. The market will get cleaned up, and then a second generation of companies will come along that do things the right way and benefit from what was learned by the first set of companies. And so we're quite bullish in different categories of lending. Insurance, on the other hand, is an area we think is way overheated. There's a lot of snake oil being sold, I think, by insurtech companies. You've got largely companies that are effectively lead generation or traffic arbitrage companies that are just reselling somebody else's product, or you've got a company that has 100% platform dependency on a carrier or reinsurance partner and is just a captive for that company. We think the equity opportunity is in building fully integrated, vertically integrated insurance carriers. But that's a very long-term game and a very capital-intensive game. And I think it's being done by folks like Clover and Oscar and a bunch of other companies that have emerged. But that's a less common model than some of what you're seeing in insurtech, which I think is going to lead to that rash of companies in the first generation going by the wayside so a second generation can emerge.
You guys all receive, I'm just imagining, I get tons of emails, pitches for story ideas and everything all the time. You guys must just get umpteen pitches for the companies that people want capital for. So when we talk about those ideas that come across your desks, they already have to kind of pass through a certain vetting process before you guys even see them. So they've already gone through a rigorous vetting process at that point. But then when it comes across your desk, what exactly stands out in terms of a proposal, in terms of an idea, something where an entrepreneur wants money for a fintech company, and you will say, hey, you know, that could be interesting. I mean, Rick, you got a lot of money, as you guys all do. So if I want to check from you, what do I have to do, and what kind of story do I have to tell?
I think, you know, there's, at a base level, there's things like team and market opportunity and all of those.
Those are all soft.
Yeah, kind of
right,
soft
I can
things.
those things.
You know, I think, and what I tell my own companies too when they're out fundraising is, what truly makes you different, right? And really focus on that one thing. And it has to be something pretty extraordinary. I think that a lot of companies fall into the trap of, hey, we do everything well, versus we do everything well, but look at this one thing and it's completely different and it's completely going to change the market. And that's what really captures my attention, at least. And, you know, I think in terms of being a little bit more concrete around that, I think it's building or enabling a completely new type of product that nobody's seen before, and convincing me why we need that product or what the trends are that kind of really builds demand for that product. I think, you know, the easiest thing is traction, right? What is it around this company that is showing such product market fit that either it monetizes extremely well or it has captured the engagement levels of some size and some scale of audience that is different than anybody else out there? And the third piece is growth, and how those three pieces kind of, and those three vectors kind of work with each other is really what captures my attention, even at the earliest stages. And, you know, at the earliest stages, you can kind of think about what is it that sets me apart? What is it that's resonating with my customers? And again, I spend more time on the consumer side of things. And, you know, while consumer is crowded and while it's a very hard place to invest in, if you look at the biggest outcomes and the biggest success stories in this space, it's all consumer companies. At the same time, when you kind of think about the infrastructure side of things, I think what's interesting about those companies is those are really kind of fundamental. The companies that are interesting there are the companies that are fundamental platforms that can really enable a space. So, you know, one of our co-investments in Plaid, where you can't talk to a company that's building a fintech company at the earliest stages today that's not thinking about or using Plaid yet. Those are the kind of companies that we get really excited about, because it's, you know, you're riding on these curves that just stack customers, and any one of those could blow up at any time. So, you know, we kind of think of those as picks and shovels businesses.
I think with how much activity there is in fintech and how early we invest, the only thing we can do is come to it with a prepared mind. We're not trying to prognosticate the future ourselves. We're trying to glean the truth from people who are weaving the future and identify what we believe, which of those stories we believe. And ultimately, we're trying to decide whether their story leads to an experience that is 10x better than anything else that exists in the world, and whether they can be the best in the world at delivering that experience. And so it's easy to, particularly given all the activity in this space, to shut down and say, I just don't want to hear another pitch about X anymore. But particularly at our stage, it's really important to have a point of view, but be flexible in our thinking.
Yeah, and that attitude of I don't want to hear another pitch about X anymore, I think that's what kept people out of Facebook and everything else, right? Or Google. You know, we don't need another search engine, we don't need another social network. And so I think we've learned over time to be open-minded. And I think your question was, if somebody sends us an email, how does it get our attention? Like, why do we open it? And I think there's a couple of things. Like, first of all, use bullet points, right? Very short, very concise, and immediately, if you have traction, number one thing, like, I have this many customers using it, here's my engagement. Show us something that surprises us, right? And so as Satya said, having this prepared mind, we have a clear way about how we think about the market. Every company I've invested in has come in and shown me I was wrong. They've shown me some insight that I wouldn't have believed had they not come in and shown me that they had data that really disproves sort of what our initial thoughts were around the marketplace and around how people behaved. And it's because that entrepreneur had some unique insight, and maybe they had it initially, maybe they learned by just sort of execution along the way. And so we invest, where I love to invest is that sort of Series A, almost B space where there's a little bit of product market fit. You're kind of seeing the customers come, and you're seeing the engagement. But now we can jump in and we can really figure out how to help that entrepreneur scale and hire people around them. And that's where operationally I love to be, is on the product and the marketing, and really getting that fit right and helping people ramp and scale. So really, it's like Satya said, we see a lot of these, even lending. I'll still look, because I'm like, there will be something in here where some entrepreneur has figured out some critical insight or some acquisition channel that other people have just not seen yet.
I think one thing a lot of founders overlook, especially at the early stages, what is going to be sustainably differentiated over the very long term. They might be able to build a great business for the next 2 or 3 or 5 years, but what's going to allow that business to succeed and thrive over the very long term? And in fintech, that tends to be around either proprietary acquisition or proprietary data for the most part. And so that's something that tends to be overlooked, I think, quite a bit.
Or regulatory, building regulatory moats behind yourself. That's one thing in fintech. When you look at these huge companies, a lot of people stray away from things that are highly regulatory, but when you look at whether it's Lending Club or Airbnb or Uber or Skype or whatever, or PayPal, those companies were clearly, not on the gray line of the regulatory. They were sort of they were clearly in the red, right? And then over time, they worked into the gray and then into the black. And so I think, those moats that you talk about, like sometimes taking on new regulatory areas, but doing it in a really smart way where you work with the regulators and you're open about it and you try to create a construct for a new law. And a lot of the insurance companies are the same way. They're trying to kind of come up with a new framework and work really, really well with the regulators. And that's where I think there are opportunities as well for creating that moat.
What's the most effective way to build that ecosystem with the governmental bodies or the SROs or the people out there who kind of are an integral part of how industries operate, like in banking and insurance or like in consumer lending or anything else like that? How much do those regulators or those SROs play into how you view a company's future prospects or investment thesis?
It's a huge part. I think at a base level, you have to be thoughtful about it. And I think the most important thing is knowing what you don't know, right? And not going in guns blazing and saying, that's not going to matter, right? And we want to do this, this, and this with the product, and we want to show this growth, and the rest will take care of itself. I think that's the most important thing, because there are a lot of smart people out there that have done this before that we can surround entrepreneurs with and companies with, and make sure that these companies make original mistakes instead of unoriginal mistakes. I think the biggest thing is making unoriginal mistakes and kind of setting yourself up to make those mistakes. And everything else I think is pretty tactical at that level.
Yeah, I'd say that it's the focus on the regulatory issues is super important from very early on. And what we like to see is a company that is spending time educating the regulatory bodies as much to educate them as to understand their interpretation of the regulations, because while the language says one thing, the interpretation can vary from jurisdiction to jurisdiction and body to body, and that allows them to develop a point of view around where they can push that boundary and where they can cross that line potentially and have things work out in their favor as opposed to against them down the road.
Rebecca, you opened the door for this about about your regulatory line and
Right.
where people fall. So how much does it play into how you view
I
companies'
think
prospects?
I really look at the CEO and what their attitude is, to be honest. There have been a couple companies effectively that have failed because of a very cavalier attitude towards regulators, right? People who, instead of working with regulators, just hire lobbyists in DC and spend a bunch of time there thinking that they were just going to change everything overnight. And so I really look to the attitude of the executive team and the CEO and the culture established in the company to where, it's that fine line of forgiveness versus permission, right? But don't go stick your finger in the eye of the regulators and tell them that. I mean, there have been cases of companies that I'm sure you know that have done that and basically thought, states had preemption over federal and things of that nature. Like, just don't do that. Try to work, constructively, and it's sort of this tense framework where you're trying to work with them, but at the same time push the regulations at the same time, right? And so, but if there's somebody, or I think there's probably really very few examples of huge success in financial services where the founder really just sort of thumbed their nose at the regulator and said, here, we're going to go our own way, because they can pretty quickly shut you down.
So I'm going to pose out there, because we've got single-digit minutes left here, and I'm going to keep us on time for the sake of our audience. Hottest, coldest parts of fintech right now. What's got you most excited? What's got you most kind of like, I can take it or leave it kind of thing? And we'll start maybe at the end with Satya. As you look at the companies who are coming to you right now, what part of the fintech atmosphere, that ecosystem, has you the most, hey, like, I want to get in on this? And what can you say is a little bit more like, you know what, I'm okay, I'll pass?
I think for us, the things we're excited about right now are infrastructure related, like our investments in Plaid and Chain as good examples. We're really looking for companies that are enabling innovation to happen in a different way that it has happened over the course of the last few years. And we think that those companies have unleashed a lot of innovation, and there'll be many more around compliance and servicing of loans and a bunch of other infrastructure pieces that allow the experience that's being delivered to be dramatically better. And then to the second part of your question, as I mentioned earlier, we think InsurTech is very overheated and is going to lead to a lot of companies that frankly shouldn't exist being out in the world, causing trouble for maybe some of the companies that are taking a better approach to things. But in the long run, there'll be a next generation of companies that we'll be excited to pay attention to.
Rick?
I think InsurTech is very hot, and I think that if you're...
That's what makes a market though, right?
Exactly, and I think if you're clear and have a very clear thesis and bar around it, you can find really interesting opportunities there. Because I think there's a ton of data sources now and a ton of ways to generate that data that weren't available before. And I think at the same time, at NEA, we've learned a lot from Metromile, which is at scale, which has raised a ton of capital and has done something fundamentally different in the auto space. I think real estate is another really interesting area right now. Again, because I think you have the dynamics of a big player like Airbnb coming in and disrupting industry and looking at the asset differently. At the same time, I still think it's part of the American dream to own a home, and while home ownership may decline over time, it's not going to decline by an amount that I think makes it uninteresting for us as early stage investors. And I think the other really hot area that we're spending a lot of time in that we haven't made a lot of bets in is in the cryptocurrency space. And you see what the prices of all these different cryptos are doing, and the number of different tokens that are out there. And I think that in everything, coming in with a prepared mind and an open mind, it's an overheated space, but there are some real gems in there, right? And when you can find companies that are fundamentally taking advantage of the benefits of having a decentralized ledger and how that fits into the business model and the ecosystem that company is building.
I want you to hold on to that
Sure.
thought.
Yeah.
Because we are going to get to it.
Yep.
really quickly from you.
Right, so I'll try. So again, so in terms of what's hot, definitely infrastructure, whether that's blockchain or fraud or compliance or any of that, that's what we're really looking at, sort of the picks and shovels kinds of businesses, especially as these banking systems are aging more and more, and it's even hard to find programmers that will come in and work through that. In terms of what's not, I definitely personal finance. I think I've
So no more betterments, no more like
that's
that.
really no. I think robo investing and personal finance is really I think that ship has sailed to a large extent, and there's just a lot of them out there. So.
I had said to hold on to that crypto because I'm surprised it took that long for you guys to get to distributed ledger and cryptocurrencies and whatnot. We've got a little bit of time here at the end. I wanted to reserve it because it is a hot space right now, and not just from a price standpoint or anything else. We read about Ether and Bitcoins and everything else out there. I'm curious though, there are a lot of people now entering the market in fintech along this blockchain side of things. This morning we saw headlines that IBM, one of the biggest old world, if you want to call them, tech companies out there, is now partnering with major European banks on blockchain technology. So is there still an opportunity? Or to me, it's been around for such a long time now that you can see new entrants coming in, but it's not as sexy as it used to be, blockchain. I hear it all the time.
The best time to come in,
Is
though.
it?
Yeah.
That's what I'm saying.
So being too early is no different than being wrong in venture, right? And so oftentimes it's just you see the technologies and the people that jump onto that first wave miss the bigger wave behind them, right? And so I think there's the initial wave, and there are the people that go first. And I was an engineer, and I grew up at P&G, at Procter & Gamble, and it was always this sort of this whole thing of first mover. They didn't believe in it at all. It was always second mover. Like, let the first mover go out. Let them
make the mistakes.
Make the mistakes. Spend the money. Prove out the market, and then we're going to come in behind them and learn from their mistakes. To your point, not make the mistakes the first time, and then build a bigger company better. And so we've been watching very carefully in that whole first wave and held, but they've been learning. And I do think there's an opportunity, especially in the blockchain infrastructure and things like that.
It's all about signal to noise, and I think when a space becomes hot, there's just a lot more noise, but there's always signal there.
What's the signal in crypto then?
I think it's how does this fit into what this company is doing and how it builds out the ecosystem, how it's incenting both developers on top of their platforms, the users that are utilizing that system, kind of the broader base of investors and stakeholders in that company. I think people right now are viewing this window as a window in time, and kind of tying this back into the regulatory discussion of you can raise a lot of money very, very quickly with very little oversight right now. And so when that happens, there's a bunch of people that jump in and will try to take advantage of it. At the same time, there are companies that it actually makes sense to issue tokens to developers and to users and to the rest of the ecosystem in terms of a business model that hasn't been seen before, and can really power something very, very different and something very, very useful.
I'm waiting to see when ICO becomes as prevalent as IPO when it comes to capital raising. So, Satya, your thoughts here on crypto and where the opportunities
we get paid to be, especially at our stage, early or contrarian. And it's hard to say that we'd be contrarian right now if we were to invest heavily against either the blockchain or cryptocurrency. But we're going to raise our next fund using an ICO. How about that?
Okay. So tell me more, or tell us more here.
Not really.
No? No? You don't want to. You want to go. You open that door and then you just want to close it right behind you.
It has been discussed at a partner meeting or two. Let's put it that way, but it's not something.
So but the point is, without going into any more detail, I'm not going to waste my time trying to get you to open up about that. It has been discussed.
Sure.
That is a way that is now becoming not mainstream, but approaching kind of a more stable discussion within boardroom and management ranks with regards to
I think in the same way, people argued when AngelList developed that AngelList would be the end of venture capital, and we decided as individual investors to invest in AngelList before we started our funds, and think that those things can coexist. And in the same way, I think we believe that ICOs, cryptocurrencies, certainly venture funds can coexist, Because at the end of the day, you know, a coin's not going to pick up a call at 11 o'clock at night when your lead engineer gets fired. And we think that the best entrepreneurs value currency, but they value counsel more.
Okay. We've got 17 seconds. I'm going to give you guys one last question here, and then just tell us the biggest mistake you've made in investing in early stage fintech.
In early stage fintech? So I've been lucky in fintech. I could, if you broaden that, it would be different, but all my companies have exited pretty well. So in fintech, and
so I'll broaden it out.
Yeah, so
She's apparently had a lot of success.
No. I've been probably too conservative, but no. So fintech is hard because they've all been done pretty well. But you know, the biggest success, or the biggest mistake, is really, you know, investing in a company where the CEO maybe didn't value board oversight or board help. And there wasn't that, and I thought we could build it over time, the trust. And at the end, he said that the biggest challenge was that he wished he would have come to us faster for help. Because I think one thing that CEOs don't understand when you get money from an investor is that we're all in the same boat. Everyone wants the same prize at the end, and we want that company to be successful. So don't hide the issues, right? Come to us immediately, because it's much easier for us to fix those issues. Whether it's your lead engineer quitting, it would be good to know that there was a problem, you know, maybe a month beforehand, so we could start the process. And so I think the biggest mistake is not aggressively initially just establishing that relationship more securely to where there was an issue. 'Cause I love to help people when they actually have.
I get that about you.
Yeah.
You know, despite everything we talked about on this panel, I think fintech is hard, and sometimes you develop scars in the space, and sometimes that does cause you to be too conservative at the earliest stages. You know, no matter what you invest in, whether it's successful or not, it's going to take longer and take more money. And so just go into it understanding that, and you know, really understand what could fundamentally change the industry and jump in.
Satya.
Generally in our business, errors of omission are more expensive than errors of commission. So our biggest mistake was we passed on Robinhood pre-launch. Index ended up funding it 6 months later. Did the seed. Could have been us.
So there you go, guys. The red light keeps flashing at me, which means that they're going to be mad at me for going 2 minutes over. But anyway, thank you guys very much. Thank our panelists here, and thanks for having us here at CB Insights. Thank you so much. We're going out that way. Thank you very much. Thank you, Satya.